Hello, everyone. Welcome to today's webinar on using high-frequency data to monitor the economic impact of COVID-19. My name is Brian Mulligan, and I am the Chief Marketing Officer at ISI Emerging Markets Group. Today's webinar will be presented by my colleagues Alexander Ivanov, who is the Head of Macroeconomic Research at CIC, and Mingfang Can, who's the Macroeconomic Researcher for China at ISI Emerging Markets Group. I'm delighted that so many of you have taken the time to be with us today. We have attendees from a lot of different countries, and it's great to have you with us all. This is our second webinar on the topic of COVID-19, and a lot has changed since the first one that we did at the end of February, when so much of the focus was on China. The virus has now become a pandemic, resulting in a huge shockwave for the global economy. Unemployment rates have rocketed as businesses have furloughed or laid off their staff. Governments are spending huge amounts of money to prop up their economies. Stock markets are taking huge hits. Currency volatility is extremely high, and there's been a lot of downward pressure on commodity prices as well. So today's webinar aims to shed some light on the economic impact of the pandemic and show you how you're able to use our high-frequency data sets to monitor the impact of the disease outbreak on financial markets, on commodity markets, and the real economy. Quickly before we get started, for those of you who aren't familiar with what we do at ISI Emerging Markets Group, we've been in the business of providing information on developing countries for over 25 years. And we have two brands, CIC and EMIS, that specialize on providing high quality emerging market content. CIC provides macroeconomic and industry data on over 200 economies, while EMIS focuses on providing company, industry, and country research on emerging markets. The data in today's presentation is going to be drawn from the CIC database. I'd now like to introduce our presenters today. Alexander Ivanov is Head of Macroeconomic Research at ISI Emerging Markets Group. He plays a pivotal role in our macroeconomic and quantitative analysis. He previously worked as an EMIS Insights researcher, where he was in charge of the industry analysis for China and the industry forecast for various emerging economies. Mingfang Can is macroeconomic research for China at ISI Emerging Markets, and she's based in Shanghai. Mingfang previously worked as Senior Research Fellow in the Ping An Research Institute for the Macroeconomy and as a Research Fellow at the Yikai Research Institute. Mingfang holds a Master's degree in Financial Forecasting and Investment from the University of Glasgow, and her research area includes financial regulation and stability and labour economics. Before I hand over to our presenters, I just want to mention a couple of housekeeping points. So during today's webinar, you'll have the opportunity to ask questions, and you can submit your questions using the panel on your right. Simply click the orange arrow, and we will answer as many of them as possible during the Q&A session at the end of the webinar. There are many people on the call today, so you're all on mute. So if you do have a question, you need to submit it in writing. And we also have a handout section just above the question panel where we've uploaded today's presentation, and you can download that at whatever time you like. Now, with that said, I'm going to hand over to Alexander and Mingfang for the presentation.
Thank you, Brian. Hi, everyone. Thanks for joining this webinar. I hope you can hear me. So before I Mingfang walk you through the economic impact of COVID-19, I'd like to show you some figures on the current situation of the disease outbreak. So as of yesterday, according to the World Health Organization, there are almost 1.3 million confirmed cases globally and 72,614 death cases. The confirmed cases, as you can see on the chart, is on a decline for a second consecutive day as of yesterday, and there are signs that the global economic curve may be close to its peak. Also, more than 80% of the total confirmed cases globally comes from the top 10 countries, and around 1/4 are in the US, followed by some of the Western European countries like Spain, Italy, France, and Germany. However, the epidemic curves in most of these countries are on a decline this week, and we all hope that this decline is going to proceed. So, despite some of the trends in the most affected countries may look quite similar, the scale of the disease outbreak in these countries vary. Here are the two charts that show two of the key epidemic frequency indicators. The first one, the morbidity rate, shows the proportion with which the disease appear in a given country, measured as a share of the estimated population per 1,000 people. And the second one, the case fatality rate, is the proportion of deaths occurring from the disease presented as percentage of the total confirmed cases. So the first indicator, even though it is heavily reliant on the population size, show how are the differences in terms of the frequency of the disease outbreak in the most affected countries. And it also shows how they differ from the global overall ratio. The morbidity rates in Spain and Italy, for example, are more two times higher than that in the United States and China, as you can see on the chart. The differences are even larger in terms of the case fatality rate, the proportion of deaths to confirmed cases. The case fatality rates is in France and Italy, as you can see on the second chart, the two countries with the highest rates among the most affected countries globally are even are more than 2 times higher than the overall global rate, 3 times higher than the rate in China, and almost 4 times higher than the rate in the United States. However, what's interesting here is the case with Germany. While in the first chart, as you can see, the morbidity rate of Germany was close to that of the Western European countries, the case fatality rate, on the other hand, shown on the second chart, is much lower than that of the rest of these countries. And it's even lower than that in China and the United States. So these two indicators provide a good picture on the epidemic frequency in the most affected countries. But one obvious fact is that in absolute terms, even though the disease outbreak spread in China first, it became much more severe in Western Europe and the United States, both in terms of number of confirmed cases and in terms of the number of deaths. And the reason for this may vary from the government policy, that lockdowns in some countries were imposed later than in others. It could be due to the number and the geographic locations of the zero patients or the behavior of the population after the lockdowns. But here I'd like to show you some data that also provide a good picture of that differences. So one measure that illustrates how the disease outbreak differ among some of the most affected countries, in particular between China and the Western countries, is the dispersion of the epidemic. So this scatter plot shows the regional distribution of the confirmed cases and the number of deaths of China and Italy by provinces in China and by regions in Italy. So, and as you can see, it's quite different for both countries. Even though the region of Lombardia, the blue point in the upper right corner of the chart is obviously the most affected region in Italy. The spread of the disease is relatively equally distributed if we compare it with China. The regional distribution of China looks completely different. The disease spread was to a large extent concentrated in the Hubei province, which looks like an outlier on the chart, while the spread of the disease in the other provinces and cities remained unlimited. Moreover, data shows that the regional distribution within the Hubei province would look similar with the major of the cases concentrated in the outlier, the city of Wuhan, while the levels in the other cities of the province remain relatively low. So let's add the United States to the plot, and you can see that the regional distribution looks similar to that of Italy. Okay, obviously there are some states when the disease outbreak is much more severe than in other states like New York and New Jersey. But in relative terms, the differences between uh, the two states and the rest of the country is much lower compared with the Hubei province and the rest of China. If we add Germany, the situation is the situation is similar. We have more confirmed cases. Similar to that in the U.S. and Italy. We have more confirmed cases and deaths in the states of Bavaria, Baden-Württemberg, and North Rhine-Westphalia. But the concentration level is much lower than in China, and it looks more like the one in Italy and the United States than in China, where we have an outlier, the Hubei province, while the rest provinces are on the are with much less confirmed cases and deaths compared to the average for the country and compared with the Hubei province. So besides in terms of the regional distribution, the most affected countries differ in another factor that is highly related to the mortality rates, which is the degree of the risk factor in the population. There is still a lot for the disease that we still don't know, but one of the things that has been proven so far is that there are two major factors related to the higher mortality from COVID. The majority of the deaths are people aged over 60. That's one factor. And the other is the pre-existing conditions, namely diabetes, cancer, and coronary heart disease. So on this chart, the x-axis shows the percentage of the elder population over 65, and the x-axis shows the World Bank estimates of mortality from either diabetes, cancer, or coronary heart disease per thousand of people. And the bubble size indicates the case fatality rates of the countries on the chart. So as you notice, aged population is a much more considerable factor in the Western European countries compared to the United States and the Asian countries. On the other hand, countries like the United States, Iran, and China are much more exposed to deaths related to the pre-existing conditions. However, if we take only take only the diabetes as pre-existing condition, the chart looks quite different. Germany, for example, has much more higher diabetes prevalence than the rest of the Western European countries, especially compared with the other Western countries affected by the COVID, Italy and France. The levels in the United States in terms of the diabetes prevalence are even higher compared to the rest of the most affected countries. And before I continue with the economic impact of the COVID, I just want to show you two charts very quickly that compare the COVID-19 outbreak with some of the disease outbreaks in the past, because there are still such comparisons that we can see. So this is the trend of the COVID confirmed cases around 80 days since it began, compared to three of the other recent disease outbreaks: influenza A1, Ebola, and SARS, for the same period. So besides the obvious fact that the number of confirmed cases of COVID is much higher, what we can see from the slope of the curves is that the COVID outbreak spreads faster in this period compared to Ebola and SARS, but a bit slower than the influenza A1. And on the other chart, in terms of the case fatality rate measured as percentage of deaths to confirmed cases, the COVID rate is much higher than that of influenza A1, but is twice as lower than that of SARS in the same period. So what's the economic impact of COVID-19? The indicator that shows us the earliest signs of what's going on in the economy is the stock market. So the disease outbreak in China had a devastating impact on the Chinese stock market. But I'll leave the details to Mingfang on China. But what's interesting is how the US and respectively the global equity markets reacted to the epidemic. So as you can see on the chart, the US market initially ignored the disease outbreak in China in February and remained relatively flat at its historically high levels. But then it strongly reacted on the increase of the epidemic curve in Italy and the subsequent increases in other European countries like France and Spain, as this was a signal that for the investors that the epidemic is going to spread globally and that it will turn to a pandemic. So if you think that this, if you didn't expect this, and if you think that this was strange, this was actually exactly what happened with the SARS disease outbreak in 2003. So with the spread of the outbreak, of the disease outbreak in Asia, the Hong Kong benchmarking index Hang Seng dropped from near 9,200 at the beginning of the outbreak to near 8,400 in the peak of the disease outbreak, as you can see on the chart. In contrast, the S&P 500 reacted just slightly at the beginning of the outbreak, which was, I would say, it was more of a correction after a similar period of increase before that, and then turned back to sustainable increase since then on the path of the strong recovery after of the U.S. equity market after the dot-com bubble burst 2 years earlier. Back on the current U.S. stock market decline, the sub-indices of the S&P 500 also provide an interesting picture of what to expect from the economy. As you can see on the heat map, all of the sub-categories were in the red zone since 18 and 19 of March and have remained there until now. However, we can notice that there are some sectors that show some early signs of recovery, namely the healthcare, consumer staples, utility, and the information technologies. In contrast, other sectors like industry and materials remain in the red zone as of today, even though they also show some improvement compared to the period of 18th of 20th of March, but it looks like they will recover much slower compared to other sectors. And another trend on the US financial market is the substantial decline in the interest rates following the benchmark rate cut by the Federal Reserve. So the government bonds once again proved to be considered safe haven assets as the US 10-year Treasury yield fell below 1% for the first time ever. And in Europe, the benchmark 10-year German government bond yield also dived even deeper into negative territory. And the trends in other major countries were quite similar. So what about the real economy? Even though it's early to estimate the real impact on the real sector, the indicator that is maybe the most closely monitored these days is the initial job claims in the United States. So in the last 2 weeks following the lockdown in New York and the rest of the country, The initial jobless claims in the US dropped to the levels unseen before. Last week, they skyrocketed to 6.6 million, or 10 times more than the peak during the 2008 recession. And while the numbers are shocking, especially compared to the global financial crisis in 2008, this was, in my view, wrongly accepted as an indication of a larger scale recession compared to the one in 2008. With a high degree of certainty, we can say that the global economy is entering a recession, but it's too early to estimate its scale and compare it to any other of the previous crises that we had. So what is certain is that the two crises are different. And while the 2008 recession was triggered by a financial crisis that then shifted to the real sector, today's crisis is an economic sudden stop that started in the real economy and then moved to the financial sector. And this explains the higher initial jobless claims. So one of the things that will determine the scale of the coming recession is whether the crisis will loop back from the financial sector back to the real economy. And that's the substantial role of the central banks today, to make sure that the credit is flowing from the financial sector to the real economy, and that the financial intermediation function of the commercial banks remains uninterrupted. So besides the US and the rest of the developed countries, the disease outbreak had a strong impact on the emerging markets. And while it's too early to estimate the effect on the real economy, the devastating impact on their financial markets is already visible. But the declines in the equity markets of the emerging economies were more in line with that in the US than on that in China. And the benchmark indices in countries like Brazil, India, South Africa, Turkey reacted on the spread of the disease globally, while they, I would say, they ignored the initial outbreak in China. And the disease outbreak and the growing risk for the global economy, along with the monetary policy easing of in the United States and the other developed countries' central banks, and the wild expectations that the wide expectations to ease even further led to substantial capital flight out of the emerging markets and a sharp depreciation of their currencies. So besides the sustainable trend of currency depreciation led by the capital flight, the currencies in the major emerging economies reacted on various news, like the one of the positive coronavirus test of the British Prime Minister Boris Johnson on 27th of March. So you can see on the charts that all of the currencies depreciated substantially after 27th of March, when this news was announced and triggered even higher currency depreciation. And just one slide before I pass to Mifan from China. Compared to Asia, it looks like, with some exceptions like Brazil, it looks like compared to Asia, the trend of currency depreciation in the major Latin American countries were quite different, as the currency depreciation in countries like Argentina and Colombia were more driven by local developments than on the global issues related to the coronavirus. So that was on my part, and I pass to Mingfang on China.
Thank you, Alex. Good afternoon, everyone. Today, I would illustrate how to use high-frequency data to monitor the economic impact of COVID-19 on China. The structure of my presentation is listed in the slide. First, the impacts on China's real economy through the data regarding transportation, industry activity, and prices. We could closely monitor the dynamics of China's real economy. Second, the impacts on China's financial market. With the opening of China's financial market to global investors, it's increasingly important to monitor China's monetary policy and financial markets. And the next slide shows two indicators. First, the gray area is China epidemic curve, which is the daily new confirmed cases of COVID-19. Second, the green line is the year-on-year growth rate of all passenger traffic by air, water, express, and train. This chart could help you to monitor the transportation condition in China. I use purple cycles to highlight 4 key time points. The purple circle in the bottom is January 23rd, the time that the government announced to lock down Wuhan. After this point, all Chinese noticed that the virus is highly contagious and deadly. So you can see the passenger traffic plunged significantly and reached the lowest growth rate on February 3rd. The reading is a drop of 87% compared to the passenger traffic in the previous year. The second circle is on February 10th. Most of the provinces, such as Shanghai and Shenzhen, started to resume their economic activities. So you could see a slow recovery of the passenger traffic from this time point. And also the third circle is the peak of China's epidemic curve. However, we don't observe any drop of passenger traffic after this point because this surge is due to the fact that the central government fired the old governor of Hubei province and appointed the new one. So Chinese people think the surge is a good sign of more transparency and they feel safe to resume their work. And let's move on to the fourth circle. It's on March 11th. On this day, Hubei provinces except Wuhan all started to resume their work. So you can see the passenger traffic continued to recover to a drop of 61% at the end of March from a decrease of 66% on March 11. But the reading still is negative. So it suggests that it will still take time for China to go back to normal. Let's move to the next slide. It's about the steel production. There are 3 indicators. The first, the gray area, is China's epidemic curve. And the second, the green line, is the steel production. The third purple line is the crude steel production. Steel production is a key part of midstream industry, so the production data could reveal the situation of industry activity. You could see these 2 indicators shared a similar pattern, so I would only pick the crude steel as an example to illustrate. With the outbreak of the virus, production declined by 9.3% at the end of February. In March, the production was increasing. This high-frequency data seems consistent with information revealed by the authorities. According to the local authorities, the flattening epidemic curve gave them confidence to resume activity in some regions. At the end of February, the industry sector in 10 key provinces resumed activity at a rate of 90%. These provinces account for 60% of the country's nominal industry output. Now let's move on to the next slide. It's about China's supply price of oil. You can see that the price of gasoline and diesel decreased by 23% and 26% respectively on March 18 compared to their prices on December 31st. The sluggish energy prices partly reflects the weakening domestic demands due to the halt of industry activity. China's oil price is likely to step down further because on March 28, the government announced a policy to slash the utility prices in a bid to reduce the cost of the real economy. And the next slide is about China Commodity Index, which is the weighted average of China's commodities, including industry metals, energies, agricultures, and the precious metals. So we could use this as a proxy to monitor the overall dynamics of China's prices. The index dropped by 13% on April 3rd, compared to the peak before the outbreak of virus. This is mainly driven by the decreasing prices of industry metals and energies, which account for the weight of 68% in this index. In another word, the drop of the index suggests that China's real economy is still very anemic. So let's move on to the next slide about China's agricultural product prices during the first 3 months in 2020. And the left graph shows the seasonal adjusted growth rates of all agricultural product prices and food basket price. And they all follow the same path, so I would only focus on the food basket. The growth rates of price accelerated after the lockdown of Wuhan. This is because the large-scale transportation disruptions due to the strict measures to slow down the spread of the virus. With the decreasing of newly increased confirmed case, we can see that the growth rates decelerated to 7% at the end of March from the peak of 22%. And the right graph shows the growth rate of pork price. For China, the high pork price is not a new issue. You could see that the growth rate of pork price was at a relatively high rate of 94% at the end of December, before the outbreak of the virus. But this high price is mainly caused by the African swine fever, coincided with the expansionary part of China hog price cycle. After the outbreak, the price increased further. You could see how perfect the growth rate of pork price mirrored China epidemic curve. Then at the end of the March, the growth rate of pork price remained at 100% growth rate compared to the price in 2019. So the high pork price would make the March CPI in China at a relatively high level. This could limit the room for central bank to do the monetary easing in the Q2. Then let's move to the indicator of financial markets. So you can see the next slide. On the left side, you could see it's China Financial Condition Index, which provides a comprehensive update on China's financial conditions in money markets, debt and equity markets, and the traditional or also shadow banking systems. The positive values of the index indicate financial conditions are tighter than average, while the negative values indicate financial conditions are looser than average. On the right hand, I put all the monetary policy into a table. So you could see after the outbreak of the virus, the central bank cut the rates and inject net liquidity into the financial market. And consequently, the index was going downward and reached a local zero on March 12. But as the WHO announced the spread virus become a pandemic disease, the market turned into a risk-off mode, and the people are craving for cash. So it could see that China's financial condition become less loose. So on the beginning of the April, the central bank launched another round of targeted cut on the required reserve ratio and lowered the excess reserve required rate in order to encourage the banks to support the real economy. Then let's move to the last slide. It's about China's stock market. The purple line in both left and the right chart are exactly the same one. They are all Shanghai Shenzhen 300 index, which is one of the China's most closely followed stock market indexes. It includes the 300 A-share stocks traded on Shanghai and Shenzhen stock exchanges, and is seen as the indicative of trends in both those markets. The light gray area in the left chart is China's epidemic curve, and on the right graph, the dark gray area is world pandemic curve. As you all know, on March 11, the WHO declares the virus into a pandemic disease. So we could see that on the left side, on the China's stock market is triggered by triggered a plunge on the February 3rd when the index opened with an 8% drop, the biggest fall in more than 4 years. After the plummet, the market rebounded to the local peak on February 21st. The rebound is mainly caused by the central government's quick response to fight against the virus. However, as the virus spread quickly across the world, the market started to worry about the global market, and the index became more volatile during the period of February 21st to March 11. On the right side, you could see that the spillover effect of global panic on China's stock market. The market plummeted by 15% on March 23rd compared to its peak on March 5th. Currently, China's market participants all keeping a very close eye on global markets because no one could be independent on another against the background of globalization. And also China's global value chain participate rate was around 45% in 2018. So the disruption of global chain would have a significant negative shock on China's industry activity and also on China's financial market. So that's all. Thank you, Alex.
Thank you, Alex, and thank you, Mingfang, for your presentations. Some fascinating insight there, I think, using data just to visualize what's been happening, what the trends are. I think this is these kind of unprecedented times showing unprecedented data, and I think it's always useful to kind of to break it down in the way that you have. We've started to get some questions coming in. I've submitted them across to you, Alex, started to anyway at least. I would encourage people, if they have questions, to type them into the questions box. We'll try and get through as many of them as possible in the next sort of 10, 15, 20 minutes, as it were. Alex, there was a question around, and I think it's the question that kind of most people have, which is how long will this go on? And since this is will we have to wait for a rebound, only when a vaccine is available?
Yeah, that's a very good question, a very important one. So how long will this go on from the epidemic point of view, well, I couldn't make this forecast, but the positive signals that we see from this week that the epidemic curve may, I think there is a good chance that the epidemic curve had reached its peak this week. But let's see how sustainable it will be. And unfortunately, the threat of a second wave of the disease is very it's very real. So and in terms of the economy, I think there are two parts here. First, when the economy will hit the bottom. That's a very important question. And first, it depends on the indeed it depends on the performance of the health indicator, like when the epidemic curve will hit a peak and turn to growth. That's one thing that will determine the economic recovery, because this determines when the lockdown will be lifted and the economy will go back to normal. It's not for the short-term view. One very important thing is the policy reaction. So first, as I mentioned on some of my slides, first we had the central bank's reactions. Their role here, okay, we live in a quite different time than it used to be 10 years ago, because the interest rates and the central bank capacity to react on such crises is much more limited due to the zero lower bound on the interest rate. So the interest rate were low even before the pandemic. But I think the central banks did good in making sure that the credit flows from the financial sector to the economy. As I mentioned on my presentation, they prevented the crisis to move from financial sector back to the real economy, which would have made the things even worse. Again, on the short term, it's very important how the government will react, because the monetary policy is limited to rebound growth. So here is the important role of the fiscal policy. I think, while it was quite more difficult in 2008, because there were some some countries like the United States had very massive fiscal stimulus, but that was not the case in Europe, for example. But I see signals now that in Europe this time will be different, and the government, including the German government, are prepared to increase the deficit, to increase the spending, and to do what's necessary to recover the economy. But that's in the short term, and in the long term, it's more on the supply side, because okay, monetary and fiscal policy can make the situation better in the short term, but the long-term recovery depends more on the supply side, and fundamentals like the technological growth, the digitalization, and the supply side policies of the government and the companies. So that's the supply side effect is important on how the world economy is going to recover. It could be a V curve. That's possible. It's more likely it will be a U curve recovery, and I hope it will not be an L curve recovery. So we need the economy to go back at least where it was before the outbreak started. So I hope I answered the question. Let me go. I see the questions on the chat panels. Okay, one question on China for Mingfang. There were questions on data reporting on deaths by China. What do you have to say on that? It's more on the data, I guess.
Hello. Yes, I think In the very early stage, especially in Wuhan, there are some people that they maybe get ill because of the virus, but we don't know what it is, and then some people maybe died. This kind of people, I think they are not being calculated in the in the in the data. But after this this period of chaos, I think the data, the death rate could be trusted, and I think the reason why that people could not understand that why China has a quite low death rate is because first the government are really they use a very strict measures to stop the spread of the virus, and also the Chinese people are very cautious. So for example, even now when I go outside, I will wear the medical mask, and you can see people all wearing the mask everywhere. And the third thing is because in China, we have the traditional Chinese medicine. So at the beginning of the time, and some local hospital would recommend healthy people to take some medicine. I mean the traditional Chinese herb medicine. So I think these effects together make the death rate of China not so high. Thank you.
One more question, I think, on my side. How much the situation can be compared to as the Great Depression of 1929, and can a worldwide liquidity injection help in resolving the same? Also, in times of recession, governments invest in public works in order to provide employment and revive the economy. Will the government, after exhausting all their resources in fight against COVID, be able to do so? That's another interesting question. Comparing to the Great Depression is a very interesting point of view, and especially the liquidity injection part, and whether it will resolve the same. As I said, I don't believe the liquidity injection and any monetary stimulus can fix the current crisis. Okay, without them, it will be worse. And the Great Depression is a very good example of this, because lack of liquidity injection and the decline in money supply and measured in any monetary aggregate back then was the reason why the Great Depression was called the Great Contraction. So this made the things worse. And from what I see from central bankers now, okay, they had almost 200 years to learn the lesson. And I see that they increase the monetary policy stimulus immediately. And yeah, this will make the things better, but it can't solve it. As I said, what's crucial here in terms of government policy is the fiscal stimulus, which is on the second part of the question, whether the governments are exhausted, or whether they were exhausting all their resources. If the question is, if we talk about resources in terms of fiscal policy, and I guess you mean debt, let me say that today the government debt is the least thing, the least thing that I'm worried about. First, yeah, the government debt was already high before the pandemic. It was already high before using some measures like debt to GDP. It was high even before the global financial crisis. But something that's very different, and I think it's very important, is the low interest rate. So now is a time when if you see the data, the nominal interest rate before the crisis the nominal annual interest rates are lower than the nominal GDP average growth in all of the developed countries, which means that increase of debt actually increase the nominal economy growth. So in some sense, the increase of debt actually may reduce the debt to GDP level, and that's because of the low nominal interest rate. And given that, okay, now we have a decline in interest rates due to the government, due to the central bank policy, but it was much longer trend that started around 30 years ago. And the reasons for this decline are fundamentals like aging population, technological change, inequality, etc. So there are reasons that the interest rates are going down over the past few decades. And given that these reasons haven't changed, I think this trend will continue, which will make easier for government, not just for this crisis, but for any other crisis in the future, to use fiscal stimulus more aggressively. And I think this will make them reconsider their policy in that sense.
Thanks, Alex. I think we've got time for probably a couple more questions. We'll probably close it off at the hour mark if you want to take a couple more.
Okay, one question: which sectors will be affected the most globally? Well, I believe if we judge from the previous epidemics, tourism, transportation, services, retail, I would say this will be sectors that will be more affected. Real estate, probably. But given that this crisis turns to a large scale economic crisis, I think with some exceptions, and of course with a different extent, all of the sectors of the economy will be highly affected from this. Okay, maybe at the beginning of the crisis, the effect on sectors like transportation and tourism will be higher, but then I think it will spread over the whole economy.
Maybe time for one or two.
Yep. Yeah, one more question. Does post-pandemic recovery will correct the bubbles in Asian stock market? Yeah, I guess so. I guess so because as I said, this crisis now starts. Okay, it started from real economic crisis, but then in turn to financial crisis. So there will be obviously an increase in bad loans, non-performing loans, and there will be some stress on the banking system. And I guess there is a good chance that what happened in Europe after 2011 to happen in Asia to some extent, which means more regulations on the financial sector, more regulations on banks, stress tests on financial institutions, etc. So this may be something that will have some impact on the Asian stock market. I wouldn't call it a bubble. I mean, for the whole region, there are speculative growth. There is speculative growth in some countries. In other countries, I mean, of the stock market in other countries is more sustainable. I wouldn't call the region of the equity growth in the whole region a bubble, but there are some there were some threats of the financial stability in some of the countries even before the epidemic.
Hello, may I answer the two questions related to the China's export and import situation?
Yes, please
I
go ahead.
think, yeah, I think there are two solutions. One is closer policy coordination to make sure that the global supply chain could move more smoothly. The other one is, I think, everyone would thinking about the localization of supply chain in a maybe midterm. Thank you.
Okay, I think we've got time for one more question, Alex, if you want to pick one out.
There is one question: any prediction on the impact of the global IT industry toward the end of the year? That's okay. We don't know for sure, but I guess I guess this will be one of the industries that will recover faster than the rest, because okay, first the companies in this industry are very flexible. They are changing very quickly, including in terms of crisis. And you can see back from the history how this sector recovered faster after the 2008 recessions, and it recovered sustainably even after the dot-com bubble 2009. So I believe there's a big chance that this will happen again, and this will be one of the industries that will recover more quickly than the overall economy.
Great. Look, thanks very much, Alex and Mingfang, for your presentations and for answering the questions. We are at the hour mark, so I think there are plenty more questions, but I don't think unfortunately we've got time to cover them all off. I will transmit the questions to Alex and Mingfang so that hopefully we'll be able to answer them post-event. Thank you to everyone who's attended today. There is the presentation if you want to download that from the handout section on the panel. And if you are a CIC customer, subscriber, we will obviously be publishing a lot more content, a lot more data to deal with this situation in the coming days, weeks, and months. So please stay tuned. Please visit your CIC account, speak to your CIC account manager if you need help finding the data that you need. And we'll be pushing more content out to you. If you're not a CIC customer as yet, but are interested, please do visit our website, cicdata.com, where you can find out a lot more about what we do and how we might be able to help you. But we're going to end it there today. Thank you again for your participation. Thanks again for all the questions. Just leaves me to say enjoy the rest of your day, stay safe and stay healthy, and we'll speak to you all again soon. Thank you and goodbye.